I walked out of my corporate job in June of '99. I have a degree in civil engineering. I was building power plants and refineries, and I did that till I was at a ripe old age of 36. I thought I was old. Walked into my job and quit. The next day I was flipping houses. I grew up in Mississippi. I moved out here a long time ago, back in the 80s. There's a lot of people have said that the day I moved from Mississippi to Texas, the average IQ of both states went down. So that's kind of how that worked out. But we've been doing it a while, and we have a lot of fun with it. I went to Mississippi State. If y'all don't know that, they were the NCAA baseball champions last spring. So just a little tidbit there. But what I want to talk about, and my goal up here for the next 45 minutes, is to hopefully, tell you something that you're going to walk out of this room a little better informed, a little better off in your real estate career. That's my goal here. And hopefully you'll find it entertaining to a certain extent and informative. But I want to just jump into what's going on in this market here that we have. A lot of people call 2021 the year of the investor. Okay, record number of transactions for both commercial real estate investors and residential real estate investors. We are setting records monthly in Texas and in Houston in particular. We ended the year, average price in Houston for a single family residence at a record $392,000. $392,000. Median price $319,000. Keep those numbers in your head just for a second. We're only 60 days in. The data's only 60 days in, and we've already gone from that $392,000 to almost $396,000 average price. Every month seems to be a record. I am literally obsessed daily of watching the number of actives, single family residences. I'm purely obsessed with it. I look at it daily. We've got, as of yesterday, around 1 o'clock, I updated the slide. There was 10,457 single family houses in the Houston MLS system active for sale. That's active. That does not include the pendings. Okay? We're at 1.3 months or 41 days. Austin, and I know Shanoa knows the Austin market way better than I do, but I think Austin is still less than 1 month of inventory, and Dallas hovers around 1 month of inventory. That is the number one indicator of what's going on in our market. And again, I'm literally obsessed with it. I look at it two times a day. So this 10,457, how does it stack up? That's that range, I just tell you a number until I give you some reference points, it may not mean as much to you. In July of 2010, we topped out. The all-time high of number of actives was over 55,000. How many of you were in business in the real estate investment industry in 2008, 2009, 2010? Quite a few of you. It was different. It was way different. We were buying houses up, and we were buying a lot of them, and we had to go to an owner finance model in order to move these houses. We had to go, really, that's when we really started developing our rental pool, our rental portfolio. I consider myself a total 100% expert in residential property rental and management. Not because I'm smart, because we have literally made every mistake that you could possibly make managing rentals. But we're pretty good at it now, but we were not always good. It was the only time in the history of jet lending that we took back a bunch of foreclosures. It was the only time. 08, 9, 10, and it started to taper off at that point. And we were foreclosing on way too many houses. And what we did, we put two signs in the yard. One said for rent, and one said owner finance. Well, guess which one we would do on a house? We'd do whichever person walked up on the yard first, whether they wanted to rent or needed owner financing. We had to put bodies in houses because a lot of them were negative cash flow. You can sustain $100 negative a house if you got a little money. You can't sustain $1,500 negative a house. I don't care who you are. Okay? And that's what we had to do back then. We're not in that game right now. COVID Monday, all right? That was Monday, March the 9th. And I coined that phrase, and I call it COVID Monday because that's the day that they canceled the Houston Rodeo. And I was ticked off because I had tickets to Garth and George and everybody else coming around the corner. I was mad. The next day, they canceled college sports, the NCAA basketball tournament and NCAA baseball. NBA followed right after. I wasn't happy. I wrote it down on my wall. I was curious because I knew we were in a changing environment. I didn't know what was going to happen. I thought it was going to get really bad. I was wrong on that prediction. We were slow for about 30 days, maybe 40, and then it took off and it hadn't slowed up since, y'all. It has not slowed up. But it was 18,044 houses active when I wrote it down that Monday morning. What happened? We got as low as right at 10,000 and some change. I never saw it go to 99.99. It may have went there for an hour or two, but the only time I ever saw it was slightly above 10. Then we started to climb up, and it climbed up to about 13,000 last year. Then it started back down again, and it's been going down ever since. Again, actives in the Houston market, Austin, San Antonio, Dallas, very similar stories. Okay? Again, the number one indicator of what's going on in the marketplace. Okay? Here's another driving force in what's going on in this market. Y'all, Texas is about to hit a milestone. Who knows what it is, population-wise? How many people's in Texas today? We are about to hit, and welcome to Texas, baby. We're hitting 30 million this year. I've got to change some slides in my presentations because I've been saying Texas has 28 million people. Texas has 29 million people. We're going to 30. And I think all of them were on the highway yesterday when I was trying to get here. Every stinking one of them. You think traffic's bad now? Look at what's getting ready to happen. 2030, 34,894,429. That guy really zeroed in on that number, didn't he? I mean, why don't he just say 34,900,000? But this is right off the state of Texas website. That's where the statisticians say we're going. 2040. I probably, I just turned 30. Yeah, I'll make it to 2040. I just turned 30. I'll be right at 49 then, so I'll be good. But this is where we're going. Houston is now over, the metropolitan area of Houston is over 7 million. We are expected to grow by 1.2 million by the year 2029. Again, all of this data is coming straight from the state of Texas website. Anybody here from California that's moved to Texas? Okay, California's falling every year. Every year they're falling. Idaho is number 1 in growth rate. Texas is number 3 in the country per Texas website, but I've seen articles say 4th and 5th. That's where we're going, okay? And all of these people need what? Shelter. Maybe we call it a house, okay? Jobs. What's going on with Texas jobs? We, for the first time, hit 13 million jobs in Texas this past year. Okay? Look at these gains. You guys can read them. Houston area has added 91,000 in the last 12 months. Unemployment fell to 5.2%. Here's my comment on that. That 5.2%, they don't want a job. If they wanted a job, they would have a job today. And that's the truth, isn't it? That 5.2%, they don't want to work. So in my opinion, the unemployment's really essentially zero. Okay? Would everybody agree with that? Okay. All right. When I was preparing for this, I read a lot of articles. And it's depressing to see what the media calls this a housing crisis. And I understand why. And they talk about the negative aspect of rising prices. From where I stand, I prefer the word appreciation. And I look at this as a positive for what I do. I've got over 100 rental properties. Okay, we're going to see a slide here in a minute and we'll do some quick math. How many of you own rental properties? How many of you own more than 10? You made some money in the last 3 years, hadn't you, Mr. Glenn? You made some money. Now, you might not put that cash in your pocket, but it's coming one day when you liquidate. Okay? Look at these numbers, y'all. Now, there's inconsistency in the numbers, and there's a little bit of inconsistency even with the Houston Association of Realtors. When I say HAR from here on, that's what I'm talking about. That's where I put most of the stock in, and you see from 2017 and 18, we're trucking along to the usual 2+%, and then 19 hits us, we go double-digit appreciation, 20 double-digit appreciation, and it's the first time in the history of Texas that they've been keeping data that we went back-to-back years of double-digit appreciation. All right, the articles range. On my left, I put what was the most prevailing number that I read, but the articles range a little bit. But look at those numbers last 3 years, 11, 16, and 17, and they all agree the last 5 years is 40 plus. Okay? Rental pricing went up by 13% last year. So, if you own 10 rent houses last year worth approximately $2 million, that'd be 200 apiece. That'd be a normal number for Houston, Texas, right? For a rental property, it'd be normal. Look what you made dollar-wise in your wealth. Now, for those of you who's got your calculator out, I think I've got one in my pocket. There's an argument you can take that number to 310,000 or 3.1 million using the numbers on the previous slide. So somewhere around $200,000 house in the last 3 years has gone from 200,000 to 290 to 310. Okay, I remember when I got in this business in June of 1999, and I promise y'all this is true. I remember thinking, damn it, why didn't I get in this real estate 10 years ago? I have missed out on all this appreciation. It's already happened and I missed it. And I promise you I thought that. And here we are, 23 years later, and we're sitting up here, I'm on the stage today talking about record appreciation. You read the articles, they talk about a housing crisis and rising prices. From where I stand, I kind of like what's going on in this appreciation. And we're going to talk about it in the next, as I go along here. But appreciation is the main reason you hold rental properties. I stood up here on the stage 1 year ago last year, and I said, don't get in the rental property business for the monthly cash flow. And two of my buddies about whipped me in the hallway when I got out of here. Because they own property management companies. And they teach people to invest and all that. So I've downplayed a little bit. Yeah, you can make some money on cash flow. So I'm toning it down for them. They got mad at me for saying that. But the reason you get in the rental business is your appreciation. It is staggering of what it does for you. Okay? If you own 50 rentals in 2018, I think you kind of get the picture here, right? Okay? All right, nationally, numbers are pretty strong. Everybody pretty much agrees somewhere around that 18% is what the nation saw last year. How about this year? The wide range of predictions out there. If you look at them, most of them, if you average them out, are in that 10 to 12% range. I will tell you this, we are 60 days into 2022, and all of them are revising their predictions, and they're all trending upward. Okay? Fortune magazine likes to pick on people. They pick on Zillow and CoreLogic about their ineffectiveness to predict. Okay? But they're all trending up. 60 days in, the numbers for January and numbers for February, when you compare them to 2021 numbers, they're up 20%. Okay? Already. Everybody's trending upward with their predictions. It appears that we're going to have another record year of appreciation, or near record year, a good year. Okay? I know what everybody's thinking out there. Let's talk about these interest rates. And I follow that pretty closely. In order to talk interest rates, we first must divide it into three categories. We got to divide it into what homeowners, owner-occupants is going to buy a property and live there, their primary residence, what they're going to pay. Let's talk about what investors in this room are going to pay short term, and let's talk about what investors in this room are going to pay long term. You got to divide it into three categories. You just can't talk interest rates. All right, your homeowners, owner-occupants. My data is about a week old. Okay, on March the 17th, and again, this is interest rates, national averages for people buying houses to live in that house and homestead it. 4.16 was the national average. That's up from 3.85 the week before, up from 2.65 1 year ago. You see it trending up, right? All right. I look back at what all the predictions were before the end of 2021, and the forecast was 3.8 to 4.2 from all the big boys. They are all revising and they're trending up as well. The new predictions coming out are 4.5 to 4.8 by the end of the year. Okay? That's not devastating. That's not going to kill this industry. It's not going to do it. Trending up. 4 or 5 years ago, we were in 2000, even longer, 2006, we were a little better than 5. And from 2012, since we've been in this great market that we're in, we're still in pretty good shape, you have to say, as long as we're staying in these ranges. So this is not, it's not a bad situation at all that's going to hit us. We're going to be okay. All right. So that's for owner occupants. I know everybody in here is an investor, but when you're flipping houses, a lot of times you're selling to owner occupants. So this statistic and this issue will impact your business when you're selling those houses to owner occupants. All right, let's talk short-term rates. There's, about 4 places you can go get this money to flip your houses. You can go local hard money like a jet lending, and that's really all y'all need to know today. Thanks for coming. Thanks for coming. We appreciate it. Thank you. Bye-bye. All right. Those of you that there's national hard money. One of them took me to dinner last night. Thank you, Jeff Tesh. All right. So you've got national guys, you got local guys. You got a lot of private people, okay? You got the local banks. Anybody that knows me well know that I have built my business around regional banks. Allegiance Bank, Texas Citizens Bank, Central Bank. That's who we deal with, okay? National versus local. It's positive and a negative. I'm going to say the national guys would normally beat us on rate, but we'll beat them on close time. That's kind of fair to say, I think, okay? The local banks, it's tough, okay? It's a hard underwriting. You got to have P&L statements. You got to have balance sheets. You got to have tax returns for all your entities. It's great money, but it's a little more demanding to get it, okay? Private lenders, a lot of them. The only thing you have to be careful with private lenders, they can get scared of your deal in a hurry, okay, and kind of maybe not be quite as dependable for you, okay? Short-term rates. Everybody heard the feds raised the rate. Let's get a little education. This is the one slide I'm going to throw up here today that I think most people in the room probably not as familiar with what's going on. The Federal Reserve Board raised what we call the Fed rate from 0.25% to 0.5% on March the 16th. That's the rate that these regional banks like Allegiance and Central will go and borrow money, okay? They turn around and loan it to me or to us or to this room based on the Wall Street Journal Prime, which is always 3% greater than the Fed rate. So when the Fed rate went from 1/4 to 1/2, Wall Street Journal Prime went from 3.25 to 3.5. That was the impact, okay, at our level in this room. All right? Most banks, they're not going to charge you the Wall Street Journal Prime. It's Wall Street Journal Prime plus some factor, and it's usually, we call it Prime plus 1, Prime plus 2, Prime plus 3. So they also said that they're going to keep raising this thing 6 more times, 6 rate hikes over the next year and a half. That's going to take us to Wall Street Journal Prime, which is again the Fed rate plus 3. That's going to take us to 5% back to where we were in 2017 and 2018. Is this something that's going to impact our business greatly and shut us down? No. We're right back to where we were in 17 and 18. Okay? Powell, some people call him Jerome, some people call him Jeremy, said they did this to rein in runaway inflation. That was the so-called reason to do it. Okay? How are we doing 17, 18? Doing pretty good. But that's where we're headed with the prime rates. All right, long-term rates. Landlords. I'm talking landlords here. All right? Multiple places to get it. 4, 5, 6, 7, 8 years ago, we all went and got Fannie Mae loans if you could get them, if you could qualify. Great rates, a very harsh underwriting. Community banks are great. Most of my rentals are financed through community banks. The good news is it is a great rate. The bad news is it's a little tougher to get, and you will always have a 5-year balloon or a 5-year call. All banks put that in there. They're not going to give you a 30-year rate. They're going to give you a 15, 20, maybe a 25-year amortization schedule, maybe 25, but most of them are going to be 15 and 20. All right, you're going to be at that prime plus 2, prime plus 2.5, most likely, a pretty good rate. But in 5 years, you got to redo your loan. Now, they don't put that in there so they can steal your houses. Okay, they put that in there to protect the bank against a rate hike. That's what happens. Okay, Fannie Mae, we talked a little bit about. Let's talk about non-QM. That's the new buzzword out there. The biggest game changer we've got in this market. Jeff Tesh, if you don't mind, how long ago do these products really come about? It wasn't too terribly long ago. How many years?
About 36 months.
36 months, there you go. It's a new game. It's a game changer. We are now getting non-QM, which means you're non-qualifying based on your income and tax returns. I purposely did not put it on the slide because I wanted you to listen to me. The underwriting guidelines for non-QM mortgages, which are again, long-term loans for landlords to hold rental properties. 3 underwriting criteria. Credit, loan to value, debt service coverage ratio. Okay? The loan to value, you start to get the really good rates at about 75% loan to value or less. You pretty much got to have a 680 credit score to get these loans, to get the better rates north of 700, and a debt service coverage ratio of at least, most of them are going to be around 1.2. The best way to describe that is if your rent for the property is $1,200, the max payment you're going to qualify for will be $1,000. Or if you know your payment's going to be $1,000, that means this thing's got to rent for at least $1,200 for you to qualify. You normally know one or the other, and you solve for the other using the 1.2 debt service coverage ratio. It is a game changer. 30-year fixed. Rates in the 4s to the 7s. I've heard some people say 3s. I kind of on that one a little bit. Investors, non-owner occupied, and are not just for single-family residences. How many of you have gone out and got one of these loans? Okay, how many of you are hearing this for the first time? Okay, there you go. And these have been around, like Jeff said, my friend back there, 36 months. This is new. It is a game changer, y'all, for holding rental property. 30-year fixed, you get it in the 4s. 5, would you take that? 30-year fixed, don't have to show your tax returns. Don't have to show income, credit, loan to value, debt service coverage ratio. That's what they're going to look at. Okay? My quick take on investing in rental properties. Let's jump right down to number 4. They're a pain in the butt. They are. No way around it. I use a property manager. That screens me out of a lot of it, but they're still a pain. I am a walking billboard for appreciation. A lot of those houses that we took back in 08 and 09 are in our rental portfolio, and they're worth a whole lot more today than they were in 08, I'm going to tell you. Okay? There were houses we took back in 08, we couldn't sell them for our loan amount. But now, it's a different game, a different story. Okay? There is a reason that these huge companies like Blackstone, American Homes for Rent, and the biggest one is Invitation Homes. There's a reason they exist, y'all. It's not an accident. They're pulling the money from somewhere else, from their other funds, and they're investing in single-family residences for rentals. Okay? There is a reason. There is a reason this non-QM product is out there. Let's talk about the fix and flip. I guess we're back to the rental. Guys, don't let this opportunity get by you. Don't miss out on buying rental properties and utilizing the 4% money-ish, maybe 5%, depends, 30-year fix. Don't miss out on that. It might be gone one day. I will tell you this, these non-QM, it's all Wall Street money, and they're very finicky when an event happens. They were finicky as heck. I want to say something else. They were finicky as heck on COVID Monday. They all shut down for a while. But then they started coming back. By June, July, it was getting back to business as normal for the non-QM products. But that COVID Monday shook them up. They went away. Okay? Don't miss out on this stuff. Fix and flip. Let's don't cheat ourselves here. They're a little harder to find. You know, you got to dig a little deeper. But they exist. And here's why they exist. A very smart man, 23 years ago, when I got in this business, taught me, he said, Eddie, regardless of economic times and market conditions, the distressed market is always, and he said 2 to 6%. It's always there. Okay? Those are the houses you got to get out and dig for. Those are the houses you got to do some marketing. You got to do some mailings. You got to go, flyers. Whatever way you're going to find them, you got to find them. Those are not the properties that you're going to find on the MLS. 2 to 6% of the market is always the distressed market. He taught me that in June of 1999. His name was Ken D'Angelo. He founded Homevestors, the We Buy Ugly Houses. I'm a franchise owner. Ken has since passed away. He was a great man. He was smart before his time. I pulled this off Adam Dow. It's a little busy, so let me tell you what it says. From 2000 to 2021, it's charting out the total number of flip transactions. That little squiggly green line is the percent of the flip houses as compared to the overall market. Look at the numbers. It's 4 to 7%. One blip up to 8, one blip a little lower. And this man 23 years ago, he didn't have this. He was telling me it's 2 to 6%. You look at this chart, he's pretty darn close, isn't he? It's 4 to 7%, one blip up to 8. Of the overall market is the flip market. These are the houses you got to go out and find and dig for a little bit, or spend a little bit of money marketing yourself to buy houses. iBuyers. Are there any OfferPad or Open Door folks in the room? Woo! I'm getting ready to make them mad. Okay? Right or wrong, I have said for a long time, I don't think we're going to have to worry about iBuyers forever. I know what it takes to run this kind of business, and you can't run it on a thin margin. Zillow bailed. They bailed November the 2nd. They reported, $380 million loss in the third quarter. They blamed it on a faulty algorithm. What the hell were they thinking? Here's my Texas Instrument calculator. All I need is this and my MLS iPad loaded up. That's all I need to calculate what I can pay for a house. So I don't understand how they got themselves in that shape. Okay? Open Door stock has gone from 28 to 9. They say Housing Wire, not me. Housing Wire states they're losing billions. They suspended house buying for 90 days last year, laid off 600 people. OfferPad reports a profit. I don't know. I don't know if that was per quarter, per year. I don't know. But they're out there and we have to compete with them. I don't see how they can sustain this at the margins that they buy at. And I'm on the street as much as anybody, and I compete with them. So they're there. Zillow's already gone. We don't know what's going to happen to the other two. And maybe I'm dumb, and maybe I don't know a thing, but I'm not worried about them long term. Okay, all this information coming to you today, here's where I got it from. Be careful what you read and believe. And I promise you this happens probably one day a month, maybe 2 days a month. 10 a.m. in the morning, I'll get an email from maybe National Mortgage News. Big headline. The foreclosures are getting ready to spike and come at us, and it's crazy, and there's millions of houses getting ready to go in the foreclosure market. 1:30 in the afternoon, I'll read a Bloomberg Wealth article, and it'll say, it's all a myth, doesn't exist. So be careful what you read. You don't know. They're in the business of selling ads, and they need eyeballs on those stories. So just use this stuff. It's a lot of great stuff, but don't believe every word you read out there, okay? Some other factors in play we just don't have enough time to cover today. Oil and gas industry, the supply chain. Anybody have any supply chain issues? Windows, timber, lumber, huh? It's real. It's real. I got a new restaurant opening. We're going to be finished with the building the last week of April with no Lennox AC units sitting on the roof. We can't get them. Okay? Inflation, which is tied into the long-term rates. Inflation drives the long-term rates, which drives off the 10-year Treasury bill. We just don't have time. World peace and unrest. All of these are factors you gotta have in your head, but we're not going to talk about them today. Why jet lending? We have an excellent positive reputation. You'll be very challenged to find any bad press on us at all. We really get involved with our clients. We call them, we're their second eyes to look. Shanoa said earlier, if you're new and you don't know if a deal's a deal, you just take it to a hard money lender. They're going to tell you real quick, because we don't make any money by not closing loans. And we tell you, get away from it. You might want to listen to us or to the hard money lender that you talk to. Rates, the national guys are here. Our rates start at 8.99. We are known for our speed and dependability, y'all. Okay? Change coming? Yeah. Most likely. It always does. Don't fear it. Okay? We've seen it change multiple times. What you got to do is be ready for it, and when it hits, adjust with it with conviction. We were not running the same operation in 08 and 09 as we were in 06, I assure you. And then we had to change again in 2012. Okay? Just be prepared. It's going to happen. Don't fear it. Those that adjust properly will prosper. Okay? Those that don't adjust properly can be a statistic on the wrong side of the board. My thoughts and observations. I read an article the other day that said foreclosures up 11%. I don't see it. And I don't believe it. Okay? Jet lending foreclosed on 2 houses all year last year. That's all we had. Okay? Out of a lot of loans. The market is preventing foreclosure because people that get behind can still sell it due to the appreciation that's happened and still pay off the debt and put some money in their pocket. The market is preventing foreclosures, y'all. Supply and demand. The one mistake I made on these slides was I got a great slide on building permits. And I got it from Dr. Mark Dotzer, the economist at College Station. He used to be at the Texas A&M Real Estate Center. He threw a chart up that said in 1960 and 61, there were approximately 1 million building permits issued in the United States for single-family houses. Let's go to 2022. What's that? I guess 62 years. Population in 1960 in the U.S. was 180 million. Today it's 330 million. Guess how many building permits is going to be issued in the United States this year? Between 1 million and 1.2, with almost double population. The supply and demand, according to Dr. Mark Dotcher, cannot be cured in a short period of time for housing. We're in this for a while. There's too much demand and not enough supply, and it's not going to fix it. You got to find your home run deals. You got to do some marketing. You got to dig for them. Remember the 2 to 8% rule. Interest rates are going up, but we're not in a panic or critical mode here. The positives way outweigh the negatives. We still have good interest rates, not as good as they were, but we're still good. Population and jobs. Okay? Get ready for the change. Roll with it. And I wish I was 29 again. It's a great time to be a real estate investor. I hope you got something out of this. Thanks for listening. I hope I said something that will help you in your real estate investing career. Thank you very much.